Welcome to another episode of 51 Insights, today with Garrick Hileman. Garrick, welcome to the show.
It's a pleasure, Mark. Thanks for having me.
Yeah, likewise, it's a pleasure to have you. Garrick, you were ranked as one of the 100 most influential economists in the UK and Ireland. You're best known for your cryptocurrency and blockchain research. You're the author of the first University of Cambridge global crypto benchmarking study in 2017, so very, very early. You were previously the head of research at blockchain.com, and you were also a visiting fellow at the University of Cambridge and London School of Economics. Currently, you're the adjunct professor and you're researching topics across cryptocurrency, AI, and also the rise and fall of empires. And I'm very excited today to have you here, Garrick, to talk all about crypto, macro, and what's going on in the global economy. My first question to you is, given the current global macro environment, what is top of mind for you and what metrics are you looking at?
Yeah. So thank you, Mark, for that very kind introduction. Just one thing I'll mention also, I worked at CoinDesk. I got my first job in crypto all the way back in 2013. But I was a bit stealthy about that work because my PhD supervisors at the time warned me, do not try to do anything outside of your PhD. So I wasn't publishing the State of Bitcoin in 2013, 2014 under my own name. It was kind of pseudonymous in true crypto style. But that's my earliest industry work that I would just add to my background. Great opening question on the macro environment and where crypto sits. I, came to crypto, from the generation that experienced the 2008 financial crisis. That's what led me to want to go get a PhD in economic history, study under Neil Ferguson and Albrecht Ritschl. And what I learned early on is, the central banks, which really, made a huge effort to get the global economy back up and running after 2008, they, like all of us, have a boss. All right. Everybody's got a boss and the central bank has a boss. And the boss that can tell the central bank, in essence, what to do is this devil known as inflation. And when inflation is tame, the central bank really has a lot of levers to pull on, a lot of dials to tune the economy, to bail out sectors or even the whole system. But when we start to get into environments like today, where there's steady, again, upward price pressure, not as much as we saw a few years ago coming out of the COVID stimulus, central banks start to get a little more constrained. And I think that's a really interesting kind of like situation today for crypto, to sit in this space where, central banks might be more constrained with their loose monetary policy and ability to stimulate asset markets, which is not always what they try to do, but that's a knock-on effect, than they were last year even. And so what does that mean for crypto? Well, it could be, in the short run, not so great. And I think in some ways, crypto markets right now, the prices are reflecting this uncertainty around how much the central banks can really pump the gas to juice markets and the economy.
Mm-hmm. And you mentioned that you were very early, so 2013. In 2013, there was literally nothing except Bitcoin. Today, we have a whole crypto economy. If you look back at 2013 and you look at what's happening today, where is crypto at? What's the state of crypto?
Yeah. I mean, people, who are around that early, I spoke at the Bitcoin San Jose conference in 2013. That was my first in-person crypto event. And then I met Sven from Monerium, and Jan from Monerium at a London conference later in 2013. Those of us who were around back then, in our wildest dreams, maybe imagined that crypto could achieve its current status and role. It really was theoretically conceivable. I mean, we did talk early on about these possibilities. I even started blogging in 2015, 2016 about the idea of nation states actually investing in Bitcoin and using it as a new global strategic reserve asset. So certainly some of us were imagining what has come to pass, but it's still rather shocking. You kind of have to pinch yourself. It all seems so, so established that, governments are now thinking about Bitcoin. Some have even adopted a Bitcoin strategy. It's still pretty stunning, though, honestly, if you think about how quickly we've traveled from 2011, 2012, 2013 to today. Unbelievable journey.
Garrick, you studied economic history. You also studied monetary systems over centuries. What patterns from past monetary transitions help us understand crypto's role today?
Yeah, that is a fantastic question. And I've spent a decent amount of time trying to think about that. Barry Eichengreen was one of my inspirations to go study economic history. Barry kindly met with me back before I took up my PhD at the LSE, took time out of his day. He's an incredible scholar. And he and others pointed out that during the 20th century, during the last kind of transition from the prior reserve currency regime, which was the British pound sterling, to the US dollar, it wasn't a kind of like, kind of smooth, gentle, on off, kind of like switch. Basically, the dollar became more important in the early part of the 20th century and supplanted, it seems, sterling as the primary reserve currency. But then sterling made a comeback, as I understand, in the 20s and 30s before the US dollar finally put sterling into the rearview mirror after World War II. And that was what my PhD was focused on, was the 1940s. So I guess the key takeaway there for the crypto folks is, don't expect any kind of new monetary regime to emerge in a really smooth kind of like, oh, one day we just flip the switch and we're on the renminbi regime or some Bitcoin regime or something else we haven't even considered, some new, maybe algorithmic stablecoin decentralized regime. So I expect some bumps in the road. And then the other key point I would make is that, when people talk about how long certain currencies have been around, this comes up a lot, like how long will the euro last? People in crypto, especially out here in California, have a very dim view of the of the future of the euro. I disagree, but it's important to remember that the British pound sterling, for example, of today is not the same pound of 50 years ago, and it's not the same pound of 100 years ago, and not the same pound of 200 years ago. These currencies evolve. So we may have pound sterling in existence for centuries, but in terms of, what it's backed by and how it's managed and so on, this has evolved regularly. So currencies adapt. They don't just sit there static and are unchanging. And the reason I mention that is, my PhD supervisor, Neil Ferguson, a few years back published a Bloomberg article arguing that the US dollar, to really remain triumphant, relevant, dominant, needed to embrace Bitcoin in some way, shape, or form, perhaps as a backing asset. I think that was a rather prescient perspective. I might have had, if I can, Neil, a little credit with maybe informing his view on that. But this idea that, the dollar is kind of like an unchanging, kind of rock that just never evolves, I think is not correct. And it could evolve further and may evolve in a way that incorporates crypto in some way, shape, or form. Dollars are already traveling on crypto rails, as we know, with stablecoins, but maybe there's a further evolution.
That's a great point. And speaking about a new regime, I guess you could say that thanks to blockchain and thanks to stablecoin, the US dollar today is as strong as ever, at least in terms of the US dollar global dominance. Would you support that thesis, or how do you see that?
Yeah, I think that you make a great point, Mark, that I would add a little bit to, which is that I think when we think about dominance, there's a couple of different kind of lenses or ways to measure that. You can think about, reserve assets, like what do other central banks and institutions hold in reserve? And that's roughly over 50%, close to 60% US dollars by common measures, right? There's another form of dominance, though, which has to do with the numeraire, or the unit of account in which transactions occur in. And there, on international trade, I believe the US dollar might be even more dominant, perhaps even 75% of all international trade is priced in US dollars. So the petrodollar is the famous example here, right? The Saudis cutting a deal with the Americans and FDR back in the 40s. You price your oil in dollars, we'll guarantee your security. That's played a big role in maintaining the U.S.'s dominance, U.S. dollar dominance as a numeraire for international trade, right? And then when we think about the evolution of the monetary and payment system, I think to your point, the fact that the dollar is even more dominant, 99% plus of stablecoins, and this new emerging payment rail that might cross over from crypto to traditional markets puts the dollar potentially even in a stronger position. To your point, it actually has even more market share in use than it does in the traditional markets and international trade. Having said that, there are, I think, some very serious challenges the dollar faces. The dollar is weakening in some ways too. I think, you see with the use of the dollar for policy censorship, a term that we in crypto like to use, censoring kind of regimes that are behaving badly through control of the SWIFT network and so on, has already led many governments to try to route around the US dollar kind of complex, not have payments always running through New York and so on and so forth. So, on the one hand, the dollar is strengthening with its kind of dominance of these new emerging rails and weakening at the same time. And I think that's one of the more fascinating kind of things to watch in payments and in money today.
And again, speaking about a new regime, do you think crypto is actually a new monetary regime, or is it just the rails to support existing regimes?
So from the very beginning of my teaching at Cambridge and the LSE and elsewhere, this question of is Bitcoin money has been something I've spent a lot of time covering with classes. And what's so interesting, Mark, is that I always pull the class, and this is executives. It could be executives from a multinational in Brazil. It could be bankers at a UK-based global financial giant. It could be undergraduate students in Dubai, where I was most recently teaching the rise and fall of empires, as you mentioned. And almost every class, no matter who is in the audience, when I ask, is Bitcoin money, the result that comes back is 50-50 split. 50% of the audience, even more crypto savvy audiences, will say Bitcoin is not money, and 50% say it is. And it's something that I think it's I think something that can be argued both ways. All right. So people construct arguments on both sides of this. But in my view, using the traditional economics definition of Bitcoin, or sorry, something that's money has to have meet three functional tests. Is it a unit of account, a store of value, and a medium of exchange? It really only maybe starts to pass that store of value test, in my view. And even there, when you think about, well, what kind of properties from a store of value perspective should money have, you think of, well, something that's stable and less volatile. And crypto is one of the most volatile things humans have ever encountered. It's maybe getting less volatile, arguably, but just as recently as March 2020, Bitcoin lost 50% of its value in a single day. And it's done that before. It did that back in December 2013. So anything that can lose 50% of its value in a single day, it's hard to argue that it's a stable store of value. And then, it's really not used as a unit of account almost at all. I mean, when you go into a pub to buy something with Bitcoin, you could do this in Cambridge. I did this. You come back the next week, and if you try to buy the same thing, and imagine Bitcoin has dropped 50% in value. Well, guess what? Your Sunday chicken roast now costs you twice as much nominal Bitcoin as it did the week before, because the true unit of account at that pub is not Bitcoin. It's actually the pound sterling, and you have to pay more Bitcoin for the same chicken. So it's not really money in the view of most economists, but could it become money? I mean, you could argue, anything's possible, right? We'll see.
So Bitcoin is no money. You just mentioned Bitcoin is also not really a store of value. So what is Bitcoin then? What is the thesis?
I think it is a way for people to store value in a more speculative fashion than other more established and well understood assets. So, for example, real estate or even gold, which Bitcoin is often compared to. we know that gold can be quite volatile, and it doesn't always perform well as a safe haven either. Like Bitcoin, during a crisis, we often see the price of gold fall. We saw that in 2008. The only thing that really went up was the US dollar. Uh, when Lehman failed, gold plunged. It was not a safe haven in that moment. And so, it's, I think, a way to store value in a kind of more speculative way, because you're betting on a few things when you store value in Bitcoin. You're betting on the crypto ecosystem expanding, becoming more widely used. You're betting on maybe the rise of the machine economy. I often like to point out to my students that one of the biggest barriers to something becoming money is it's hard for something to become money unless people are paid in it. There's, with Bitcoin and spending it at your local pizza parlor, there's this extra step you have to go through, right, to acquire your Bitcoin and then spend it. And if you're paid in Bitcoin, which very few people are, some people are, but very few people are, it becomes a lot easier, less friction, fewer steps to actually use it as a currency. Well, we already have a large group in this world that is getting paid for its work in cryptocurrency, and that's miners. The work that the miners do, the machines actually already get paid for their work in crypto. And if you see or can imagine the rise of the machine-to-machine economy, it could be a case where, just like when I go to France, I need to use the coin of the realm. I have to acquire euros and spend euros there. When I want something from the machine economy, perhaps one of Elon's driverless robotaxis, then I may need to use the coin of that realm. And perhaps that's a cryptocurrency because it's programmable, it integrates nicely with smart contracts and so on and so forth, right? So that's one way to imagine how you get past this barrier to something becoming currency and money because people aren't paid in it. Well, we already have machines paid in it, and maybe they'll lead the charge on this being more widely used as currency.
Mm-hmm, mm-hmm. A lot of Bitcoiners argue that Bitcoin is a hedge against the collapse of the dollar.
Mm-hmm.
How do you see that in the context of the history of monetary systems? Do you think that's a legitimate stance to have?
Yeah. So I don't see the collapse of the dollar or the financial system more generally as a good thing for Bitcoin. And this is, I think, an area where I kind of differ quite strongly, actually, in my views from the consensus in the crypto community. I mean, if I may, I might even go so far as to say I'm the one of the only Bitcoiners I know of who's consistently for years really railed against this concept of hyper Bitcoinization that a lot of people dream of in the Bitcoin world. And let me unpack that. I think you can imagine the dollar collapsing. Currencies do collapse. That's not theoretically inconceivable. It may even be probable. Most currencies don't live forever, right? Some can adapt and go on for centuries, right? But we have numerous examples of failed currencies. So I think the concern is legitimate. Let me start with that. The problem I have is people are only thinking usually one chess move ahead when they imagine a US dollar kind of collapse scenario and what that means for the price of Bitcoin or the adoption of Bitcoin. I don't think people fully appreciate how catastrophic and calamitous a dollar collapse could be and what the response may entail. So in a situation where there is a run on the dollar, people are exiting the dollar like they're exiting Silicon Valley Bank a few years ago, right? Trying to get their money out. They're scared. They're going to something. They're going to gold. They're going to, stocks. They're going to Bitcoin. Well, if they pile into anything too quickly, what we know is that the powers that be will probably try to put the brakes on that to preserve some type of financial stability. And I think there's some strong arguments, even the libertarians, I think, would need to concede that there's some strong arguments for not letting things get that destable. And it's a hard pill to swallow if you're a libertarian to acknowledge this. But, in the 1930s, the instability in the Weimar Republic and in Germany, had some really, really bad consequences. And you have to keep that historical perspective when you think about, even if you want Bitcoin to take over the world, become the new global reserve currency. And I certainly understand and appreciate that perspective. I think there's a process to get there that might have a greater chance of success than some kind of sudden hyper Bitcoinization, crisis driven rush to the Bitcoin exit. I think people are failing to appreciate the counter measures that governments might employ that could be quite catastrophic to Bitcoin if that scenario is to play out. So if you're hoping for Bitcoin to take over the world, think about the frogs slowly boiling in the kettle. I think that's what you want, not some kind of crisis driven. I know everyone's impatient, but Bitcoiners are actually quite patient, relatively speaking, I think, and just be a bit more patient. I think it's going to work out better for you.
Yeah, I agree with you. And it's certainly a multifaceted argument and certainly not binary what Bitcoin really is. And probably that question is also not something that we have answered yet, whether it's a peer-to-peer payment system or a store of value or something else. I think that's still up for grabs. You talked about risk, and I just want to zoom out a little bit, zoom out of crypto as well, and ask you, what do you think is the biggest risk right now in the current financial system?
No, well, I mean, the AI bubble's what everyone's talking about, of course. And I've historically been a bit guarded about making financial markets forecasts, at least publicly and loudly. But this spring, I saw evidence that to me that suggested the crypto run was running out of steam. So I went on record publicly with that call, and I think that so far has been proven quite accurate. I see signs that make me nervous about the near-term improvements in large language models. And if the innovation starts to slow down, if ChatGPT 6 underwhelms, like many people thought ChatGPT 5 did, I kind of disagree with that. I think there was enough improvement that it certainly could sustain the investments. But, if the benchmark models start to really fall flat in terms of what they're delivering in terms of improvements, I think you're going to start to see more concerns about the CapEx investment in AI, which is really holding up the financial markets in a big, big way. And then you could get this kind of really nasty unwind, right? I'm old enough to remember the dot-com bubble. I was in San Francisco working at a tech incubator with one of Bill Gates's good friends. We set up and saw that whole rise and crash. And so I'm one of these people who's been on the ground floor for a couple bubbles, the real estate bubble as well, 2006, 7, 8. I could very much see that kind of unwind happening in the AI space, and that really nuking financial markets. And then you have to ask yourself, well, then what? Well, again, we come back to the point I started with, which is who's the central bank's boss? Inflation. Central banks are incredibly powerful institutions if they have room to maneuver, but we're already seeing an uptick in inflation. And as Lenin famously warned, and John Maynard Keynes agreed with, the best way to basically destroy democracy and trigger revolution is inflation. It's a really powerful phenomenon that can destabilize things in a big way, as we saw in the 1930s, and 20s in Germany and so on. So, I do worry a little bit about the inflation boss constraining central banks. And then what? Then what? It could be really painful. This idea that we somehow have figured out a way to avoid another Great Depression, I don't believe that. I think that scenario, especially as memories get more and more faded and people don't realize how horrible that time was, we may sleepwalk right into that again. But I'm a techno optimist. Let's end on a happy note. This quick question. I think AI is phenomenal. I'm much more bullish on where it can take us. I think it could be bumpy in the short run, but I think if we can figure out a way to smoothly get through these AI winter periods without too much damage, we could end in an incredibly exciting, happy place in the next decade. And the investment and party keeps going in markets.
Let's zoom in a little bit and focus on stablecoins. I know that you already wrote about stablecoins in 2019, the state of stablecoins. What are you most surprised about when you see what happened this year and the explosion we saw to over 300 billion in market cap?
Yeah. No, that was another thing I got right. I don't get all my calls right, but my intuition on what to research seems to always in crypto at least, be a leading indicator. And yeah, to your point, I got interested in stablecoins actually much earlier than that. There were a few folks, Robert Sams, JP Koenig, David Andofato, and others who started talking about FedCoin and central bank digital currency, and that was actually what piqued my interest originally in this kind of stablecoin space, going all the way back to 2014 timeframe. And then got involved with stablecoin projects in 2017, and then started doing research and publishing in 2018, 2019. And it just seemed obvious to me that this product, this stablecoin product, could really solve one of the big problems that attracted many people, including myself, to crypto to begin with. This idea that why isn't money fast, free, and instantaneous like email and text messages? Jeremy Allaire deserves a lot of credit for, I think, really championing that concept early on. He thought Bitcoin could deliver on that kind of problem, and pivoted to stable coins, because Bitcoin isn't something people always want to spend. And that's okay, by the way. There's nothing wrong with hoarding your Bitcoin and having it as a store of value. If all that Bitcoin ever becomes is digital gold or a database, a network for various activities, a timestamp ledger, NFTs, et cetera, whatever you want to use it for, that's not such a bad outcome, but it doesn't necessarily solve this other problem of how do we make money more like text messaging and email, fast, free, easy. And stablecoins really, to me, screamed loudly that, hey, we could potentially do this. We're programmable like Bitcoin and Ether. We're usable with digital wallets and crypto exchanges. And we are stable, and it's worked, really well. They have absolutely achieved a very strong product market fit. And, that possibility wasn't hard to imagine back in 2017, 2018. So I'm not surprised. I think the fact that regulators have given in and the banking system has allowed this to happen is, I guess, maybe the, bigger surprise, but we'll see. It's still pretty early days. I mean, the Genius Act was passed, right? But it's like a multi-year implementation. It's still early days in kind of the post-Genius Act world that we inhabit now. And I guess I think the jury's still out on how widely stablecoins kind of like creep into everyday life.
Yeah, I agree. So during the last cycle, I remember in 2019, 2020, 21, many talked about CBDCs, central bank digital currencies, and very few central bank digital currencies have seen the light of day so far. What we've seen is an explosion in privately issued stablecoins like Tether and Circle, the most dominant ones, almost making up for those 300 billion total supply right now. Why do you think that's the case?
Yeah, boy. Yeah, I had a pretty good zinger that got the attention of my friends in central banking a few years back, when it became apparent to me that central bank digital currency was going to overpromise and underdeliver. There was a lot of hype, exactly as you said, Mark. You remember that time period really well. Where are we now? Well, there were huge problems with central bank digital currency from the beginning. The privacy trade-offs, the concern that you might exacerbate a financial crisis. You might cause Silicon Valley bank type runs into the central bank digital currency and make it all the more easier, because you don't have to go stand in line at the bank like you used to in the 1930s to get your money out. You push a button, as Silicon Valley Bank learned the hard way, and money can flee instantaneously. So do you cap how much CBDC the average retail customer can hold? Do you have different interest rate policies for CBDC versus commercial bank money and so on? I mean, there's a lot of complications. And then you layer in the fact that, frankly, very few governments are good at technology, right? And there's a really strong technical proficiency, I think, that's required to pull off a CBDC, and risk if you get it wrong. Cyber attack risk, which I think most people don't appreciate how conservative many central banks are. They don't like to take risks. And this is a whole new attack surface you open up to something that's critical infrastructure, the monetary system, that wouldn't exist without a CBDC kind of type instrument. And then you get into the political side of it, the concerns about a panopticon, a all-seeing Sauron type, all-knowing state that sees all, knows all, Those are real concerns, and that ran right into, kind of like, in America at least, privacy concerns that put an end to the dream of CBDCs. And the private market, I think, was pretty happy to see that dream end as well, because banks like that they can create the vast majority of our money. 90% plus of our money is bank created money, right? It's not minted by the government. There is, of course, dollars and coins in our pockets still. They haven't gone away yet. But again, one of the big secrets, that I try to dispel in my teaching, so few people, Mark, actually know that it's commercial, private, for-profit institutions, banks, that lend into existence the vast majority of our money. That's not widely known by the man and the woman in the street. Banks like that power. They want to keep it.
And meanwhile, Europe just announced that they're going to launch a euro stablecoin issued by the ECB. Even though, and you mentioned that at the beginning, 99% of stablecoins are denominated in US dollars today. Why do you think that's the case? And are other nations just asleep at the wheel, or what are they doing wrong?
Yeah, I think that's going to change. I think we are going to see other currencies, including the euro, taking market share from the US dollar stablecoins. And it reminds me a little bit of 2018, 2017, when Tether had 99% of the stablecoin market. There were other stablecoins back then, but it's the same story. Tether was 98, 99% almost of the whole stablecoin universe when there was 2 billion or so of stablecoins. And it's come down a lot, right? I mean, USDC has taken huge market share, and others have come in as well. And I think that seems like a healthy development for stablecoins. And I think it will be healthy if we see other currencies like the euro, and others rising in the stablecoin league tables. In terms of what the European Central Bank is doing, look, I've talked to people who have worked on the European Central Bank digital currency. They've been frankly pretty frustrated with, the pushback, the politics, the technical challenges. It's been a frustrating project. So I'll believe it when I see it, I guess. In terms of what impact it would have. I mean, it could be significant. Well executed central bank digital currency could be a really interesting, powerful financial instrument to do a number of really useful things in an economy. But let's go back to COVID a few years ago. The stimulus checks, I wrote about this on my blog about the advantages a digital dollar would have if you were putting out stimulus checks. You could actually track that the money was received. There was huge fraud, huge inefficiencies in terms of the speed at which funds could get to someone. A lot of benefits if you could digitize those stimulus payments, for example. You certainly would create a public institutional competitor that could maybe drive down the costs of the financial services system. If you think of the financial services system as a middleman and extracting rents on an economy, on the productive parts of the economy through, high fees and exorbitant interest payments and so on, you could see a central bank digital currency competing to put downward pressure on that tax, if you want to think of it that way, on the productive aspects of the economy. So I think there is a case to be made for central bank digital currencies. It's just a complicated one. And there's a lot of execution risk and potential spillover effects, anticipated and even unanticipated ones when you get into things like cyber risk. So the story of CBDCs is not over.
I want to move on a little bit and talk about tokenization. You highlighted a couple of years ago a critical limitation of tokenizing real-world assets. You called it the trust boundary. You noted that while a ledger is immutable, it cannot verify the veracity of off-chain data entering the system. So meaning garbage in, garbage out. And we've seen a renewed push this year from big institutions, most prominently probably BlackRock, pushing into the tokenized real-world asset space. Have we solved that problem, or what's your view today on that?
Yeah. I think a lot of the concerns still stand, but there's powerful arguments and powerful institutions, as you mentioned, getting behind tokenization. That's been true for a number of years now. And I think the reasons are pretty compelling. You know, a lot of people want access to U.S. equity markets. For example, they want to be able to invest in NVIDIA or other stocks. And opening up traditional U.S. brokerage accounts it's complicated. It's not a great user experience. It's not even possible for a lot of people around the world. And so this idea that you could expand access to a category like, say, domestic equity markets through tokenization, and integrate with some of these fintech companies like Robinhood and others who are much better at building compelling user experiences and apps than traditional banks, which have struggled uh, to attract engineers and software talent. I think that makes a lot of sense. You could expand access to a range of asset classes, things we've never been able to do. I mean, I think one of the more interesting examples that has been kind of thought about for many, many years is this idea of tokenizing real estate, and having kind of a crowd shared down payment to help first time home buyers. Or, there's all sorts of things we've never been able to do that tokenization opens up. You still have the fundamental problem that you're talking about a digital instrument representing something that's not digitally native. That's the great advantage of Bitcoin, is it's digitally native. It lives entirely on the blockchain, whereas the real estate doesn't. The gold that we've tokenized, and that's been a relatively successful, I'd say modestly successful example of tokenization. It lives somewhere else. So you've got to bring in all this custody and auditing and offline, functions that require trust and really undermine kind of the ethos of what a blockchain is about: trust minimization, risk reduction, and so on.
We just had Carlos Domingo on the show. He's the founder of Securitize, one of the prominent tokenization players. And his view on that is that it makes sense to tokenize, but instead of focusing on illiquid assets, you need to focus on assets that are already liquid and then bring it on the chain, because you need a market, and the other way around, it doesn't really make sense.
Yeah. I mean, look, the success of stablecoins, I think, highlight how, incredible tokenization can be, right? Like, the case has been made successfully. There's product market fit here, but there's definitely execution and implementation risks. And it's not really, it's more fintech for me. I think of stablecoins. This point's been made on by others, that stablecoins are kind of almost more fintech than crypto. That can be a kind of useful lens to think about what is, tokenization versus what is Bitcoin or Ethereum, or something that's really truly digitally native, trust minimized, and more cypherpunky, right? Tokenization is not very cypherpunky, and that's okay. That's okay.
Yeah. Garrick, in your research, you also highlighted the institutional preference for permission systems. And in 2025, we saw a lot of companies capitalizing on that. We saw Circle launching their own chain. We saw Stripe launching their own chain. And now we have that playing field of permission corporate chains versus open permissionless chains. How do you see that development, and how do you think that is going to play out?
Yeah, to me, this is one of the funniest things in my time in this space, because human nature is human nature, and that's why historians often are the best forecasters and futurists, is they understand that, yeah, the times change, the tech changes, but boy, human nature doesn't really change. And yeah, permissioned blockchains have some real attractive elements for corporations in particular, who, I think, it's easy to kind of bash this corporate chain phenomenon, but keep in mind that, companies have to worry about things like regulations and privacy and customer data. And so I get it. I get why there's ongoing and you could argue renewed interest. And we're back where we were in 2015, when Bitcoin was bad, blockchain good. We saw, Blythe Masters and others out there at the first CoinDesk consensus conference, touting the rise of distributed ledger technology. So this all kind of echoes and rhymes a little bit with me to that period. And, you get into, I think, some real kind of trade-offs and fundamental problems, though, as soon as you start trying to erect your own chain with its own, standards and interoperability issues. And it's just not very open. It's like, have we learned anything? on why DLT was largely a dud and wasted a lot of time and capital. It lets CEOs tick a box and say, yes, I have a blockchain strategy. We're running this DLT pilot over here. But I'm not really sure that much was learned based on what I'm seeing with the rise of all these corporate stablecoin chains. And I don't know that it's going to end any better, frankly. I think there's huge advantages to open networks like Ethereum and Bitcoin and others that allow kind of an open playing field with interoperability and have a huge moat, by the way, already in terms of developers and established, liquidity and so on. I mean, yeah, I'm not, to be honest, super bullish on those efforts, but we'll see.
Yeah, I agree. And I actually have a thesis on that. I think it's probably going to be a hybrid future where we will have permission chains, and those permission chains will plug into permissionless chains, and that will kind of live side by side. I think what JP Morgan launched with DBS Bank a couple of weeks ago, where they use their permission chains and then Ethereum in the middle to coordinate and transact between their permission chains. I think that's a very good example of how this could play out.
Yeah, the corporate chains have a big advantage in that because they're new, there's new equity to allocate. There's new kind of like pieces of the pie that you can use to incentivize the best and brightest and attract them to your project, attract teams. The Ethereum ICO and pre-mine already happened, right? And there's been various efforts by Vitalik and other thinkers in the space that answer this question of how do we incentivize and fund ongoing development. Do we tax transactions or do things? It's a complicated issue, right? But that does give the corporate chains a bit of an edge in terms of being able to spend a lot of capital, right, to achieve adoption and attract talent.
Garrick, you've been around longer than most of us, and you've probably seen more layer one ecosystems and launches and layer ones disappear again than most of us. If you look at the layer one landscape today, how do you see that? And how do you assess different layer ones, and what layer ones are you most bullish on?
Yeah. Boy. Yeah. You made a point earlier about how in 2013 there wasn't anything but Bitcoin, and figuratively that's true, but there were actually other things going on back in 2013 besides Bitcoin. There was Purecoin, there was Namecoin, there was other things, Litecoin, just still around, I guess. Yeah, the layer one landscape. Well, look, I think what we've learned is there is a lot of really interesting tech that could justify launching a new layer one in theory. But, the idea that you're going to supplant, I think, the leading layer ones in this space at this point is, I think, a tough argument to make. And, we'll see. There could be some new whiz bang solution that needs its own layer one, attracts enough capital and excitement, and really does achieve kind of escape velocity. But I think, investors in the space, developers should be skeptical of those attempts to launch a new leading layer one. I think there's just been so much capital destroyed and, value destroyed chasing the next Ethereum, the next Bitcoin. It attracted a lot of talent, it attracted a lot of innovation, but I don't know that we're going to see a repeat of like the 2017 ICO layer one phenomenon again, where there's a wide proliferation of EOSs and Tezos, and sorry to name names, but yeah, there's just been a lot of battlefield deaths, and I think people are pretty burned, and that's going to be the case for a while. We'll see what tech emerges. It's nothing's impossible, to imagine in crypto. That's what's so exciting about it.
Yeah. From your perspective as an economist, are there any mental models that you use to actually value those networks and layer ones?
Yeah, this has been a struggle, right? Like, how do you value these things? I think the general feeling is a lot of the value is going to accrue to the application layer, and that perhaps, there will be certain layer ones, that can, attract value and need a certain amount of value to have a certain amount of security and so on and so forth. I think, there's ways to kind of like start to model that and think about that. But it's a big struggle, right? Like, what is this all worth? I mean, that's been part of the fun, and part of the problem with crypto is we can speculate on what everything is worth, and without really having anything like a discounted cash flow model to kind of like really, in a more scientific fashion, business school friendly fashion, actually value these platforms. So I think there's still a bit of a struggle there. I think yeah, I'll stop there. I mean, it's a big conundrum, the valuation challenge for crypto, and what is this all worth? That's why a lot of it's heuristics and like, oh, gold's worth this, Bitcoin should be worth that. Visa and MasterCard make these kinds of profits, so maybe we can discount that and assume this and this will make that kind of profit. You know, it's a lot of like really rough, kind of crude analogizing that frankly informs valuation guesses.
And Garrick, in the spirit of intellectual honesty, what is the strongest argument against the institutionalization of crypto that actually worries you?
Yeah, this worries me a lot, actually. I think I was a bit early to worry about the rise of, a company controlling 3.5% of Bitcoin, which is what its estimated strategy and formerly MicroStrategy and Michael Saylor control today. I mean, this is getting to near Satoshi level, Satoshi level of ownership. To my knowledge, there's not been an announced cutoff. Like, is he going to stop at Satoshi's stack at 1.1 million, we think, or is he going to go beyond that? Where does this end? The reality is, yes, having a buyer like strategy, a very creative, and hats off to Michael Saylor. I mean, incredible accomplishment so far. We'll see how the story ends. It's not over yet. Concern is, you know, is you get a BlackRock controlling a huge chunk of Bitcoin with the ETF, with Michael Saylor here and Satoshi's original stack. The more concentrated the ownership crypto becomes, the less useful it is for something like payments, maybe, right? If you've got a dozen institutions largely controlling all of the Bitcoin, Coinbase has a huge custodio position, BitGo, et cetera. I mean, it's just too concentrated to ever even hope to become a currency or some kind of new form of money. Not to mention the fact that these entities will undoubtedly wield some kind of influence over the network and its development. I mean, it's just not realistic to think that, these will be benign actors who will let the core devs do whatever they want and the community, through rough consensus, kind of continue to chart their own course. I mean, where the rubber meets the road here is, imagine Bitcoin wants to adopt a more privacy forward kind of technology, and it starts to run into concerns around threat finance and money laundering and these kinds of things, which the Trump administration, as pro crypto as it has been, has continued to crack down on kind of this money laundering side of kind of digital currency. You could see BlackRock and others saying, wait a minute, you cypherpunks, we may be sympathetic to your desire to have more privacy and liberty and censorship resistance, but I've got shareholders. What you're doing threatens the value of my stack. I'm going to fight you, right? So that's, I think, one of the biggest risks of further institutionalization, is it gets too far away from cypherpunk kind of principles, and it also undermines its potential for, say, currency use, because it's too tightly controlled.
Garrick, we're almost at the end of the show. Last question I have for you before we do a short lightning round is if you had to define a plausible end state scenario for crypto in, let's say, 2035, grounded in economic history, what would that look like?
Yeah, look, I'll just stick with Bitcoin here because it's the biggest, it's the original. Look, I think there's such strong arguments for why Bitcoin should supplant the total market value of gold. I get that gold, look, it's arguably orders of magnitude more decentralized. It's secured by the laws of the universe. Yes, I know some physicists figured out a way to kind of, through cold fusion, I guess, convert mercury into gold, maybe was what I heard. And Elon might go out and get some gold from the asteroid belt beyond Mars. Look, I mean, yeah, I think Bitcoin's so superior. This idea that we're going to be using a rock, I've got a copper rock right here that I use as a paperweight, that this is somehow going to be the anchor of our, our global digital financial system, I think is silly. So, my expectation is that someday Bitcoin will exceed the total market value of gold as kind of digital gold, and it already performs so many more functions than just what gold can do. With being a timestamp ledger and so on, and a platform for other things. So yeah, I think we're going to continue to grow. Don't expect it to not be bumpy though. Just because one U.S. administration has enacted a strategic Bitcoin reserve doesn't mean the next one's going to keep it. There could be a dump, there could be a lot of volatility. So, but I think the past is a pretty good predictor of the future, and we're going to see kind of onwards and upwards with some kind of like interesting dips between now and 2035.
And then quantum is coming around the corner as well. That's not solved yet for Bitcoin. So it's certainly going to be interesting.
Yeah. It's one to keep an eye on. I think a lot of Bitcoiners are thinking that they'll be target number one. I had this argument with some folks recently, and I tweeted about it. I don't think Bitcoin's target number one for the first quantum relevant computer. I think it's probably a state lab or a state aligned institution that gets a hold of one of these things, and they're going to use it quietly for as long as they can to try to harvest things that are worth more than attacking Bitcoin, frankly. And nation states often don't care as much about profits. Yes, if a degen in a garage got a hold of a quantum computer, target number one might be Bitcoin or Ethereum, but that's very unlikely to happen.
Yeah. Garrick, that was a great discussion. Let's do a short lightning round. Short questions, short answers. First question, your favorite cryptocurrency?
Got to go with Bitcoin. Yeah. The original.
Yeah. Then what is the single biggest lesson from financial history that crypto investors are currently ignoring?
Gresham's law, this counterintuitive concept that bad money drives out good money. In other words, something that's really good, that's scarce, like Bitcoin or gold, is unlikely to become money because of Gresham's observations.
Mm-hmm. If you were designing a syllabus for 2026, what is the first topic you would remove from the 2017 curriculum?
From the 2017 curriculum, I would definitely spend less time on distributed ledger technology, despite Tempo and what Stripe and others are trying. I think we went way too deep into that topic.
One book on crypto or economics that you would recommend to anyone?
Yeah, I mean, if you're new to crypto, or even if you've been in the space, I've been surprised at how many people don't know about Benjamin Wallace's new book that came out this year, The Mysterious Mr. Nakamoto. I would put that with Steve Levy's crypto book, which came out before Bitcoin and is really about the cryptography wars that predate Bitcoin. Those are two excellent books. They're fun to read, and they get into the history, the characters, the personalities of the people who created this whole space. So check out Steve Levy's Crypto and Benjamin Wallace's A Search for Mr. Nakamoto. Highly recommended.
And then last one, what is one thing that changed your mind when it comes to Bitcoin and Ethereum over the last couple of years?
That's a great, I don't know that I have an answer to that. I mean, it's kind of like what we imagined has kind of happened, I mean, it's, I guess the dream came true, it came through, I guess it's now what? That's the question.
Yeah.
Where do we go from here? Yeah, good question. You stumped me on that one.
Yeah. So that's a good ending. Garrick, now what? Where do we go from here? Maybe that's the topic of a next discussion that we'll have. I really appreciate you coming to the show. It was a very interesting discussion. Where can people learn more about you?
I have a website. I don't tweet very often. I occasionally will sound off on things that, rub me the wrong way, or try to give a market forecast on Twitter or X. I'm on LinkedIn, but send me an email. I love, especially if you're a student or someone in the space, I do read my email. I do respond to them. I love talking with people about interesting questions they have. So write me an email. I'd love to hear from you.
Yeah, and definitely check out Garrick's research. We'll link it in the show notes as well. Garrick, thanks for coming on the show and all the best.
Thank you, Mark. Pleasure.
You obviously liked this video enough that you got to the end. Listen, do me a favor, hit that like and subscribe button because I think you'll like it. And if you want even more, with more I mean incredible alpha, research, and digital asset market updates, subscribe to our newsletter on 51, that's the number 51, insights.xyz, and get the most actionable insights on digital assets. See you next time.